A conventional loan is the program that most people think of when they're going to buy a house. There are many benefits to this program, including a 3% down payment for first-time homebuyers, a lower monthly mortgage insurance, and the ability to get rid of your mortgage insurance faster than that of an FHA loan. My name is Matt McDonald from Premier Mortgage Lending, and today we're going to go over the conventional loan and everything that it entails, from general overview to refinancing, rates, down payment, everything you would need to know before you go to buy your house. So we're going to start with a general overview. This loan program is suited for buyers with a higher credit score and a lower debt to income ratio. For credit score, we're looking for over a 680. Debt to income, we'll go over a little bit in more detail in later slides, but we are looking for under a 45% debt to income ratio. Okay, with this loan, the biggest buyers are Fannie Mae and Freddie Mac, which is a government agency that buys loans from the lender. Why I mention that is because they have very strict underwriting standards. So there's really no wiggle room with this. Either you can qualify for the program or you can't, because the biggest buyer for this program is going to make very strict underwriting standards. So that's important to know if you're going to go apply for it and you are right on that line of qualifying. You're going to want to make sure that you are under the 45% debt to income and your credit score is higher than 680. Next is going to be the interest rates. These are generally charged based on the down payment, and what I mean by that is if you do the 3% down payment option for the first-time home buyer, you are typically going to have a higher interest rate than the 5% down. These programs, they do have a higher interest rate than government programs such as an FHA and a VA loan, but the mortgage insurance is much cheaper and you actually have the option to get rid of it faster. So in the end, you actually end up paying less for the house than if you were in an FHA or a VA loan. Next is going to be down payment, and again, just a general overview of the closing costs. Down payment, as I said, first-time home buyers have the option of a 3% down payment. With that being said, if you're applying for a mortgage, say you have your spouse on the mortgage as well, if you're not a first-time home buyer, but your spouse is a first-time home buyer, you are eligible for this benefit, for the 3% down payment. Both do not need to be first-time home buyers. Only one person on the loan application has to be a first-time home buyer. If you are not a first-time home buyer, the minimum down payment is going to be 5%. So just a little bit higher, but it's not 20%, which a lot of people kind of get stuck on and think that they have to save up for a house. 20% is not the minimum down payment. 5% is going to be the minimum down payment for a conventional loan. Okay, closing cost. Again, general overview, we're gonna have our broker fees, we're gonna have escrow payments, and we're gonna have title fees. There's no upfront mortgage insurance like an FHA loan, so you don't have to worry about that. And again, the escrow payment is only needed if you're choosing to open up an escrow account. The escrow account, for those that don't know, is your state taxes, for your state property taxes, and your homeowner's insurance. What that is now is the lender opens up an account for you so you don't have to worry about paying your property taxes with an actual check from yourself. You deposit money into this account every single month, and then the lender pays your taxes for you. So you don't have to worry about it when the state comes knocking for their property taxes. Okay, we highly recommend doing this since it's a less stress on you. You don't have to worry about saving money yourself. We just automatically collect it and then we take care of it on our end. Okay, for Massachusetts, we need 4 months of escrow payments because Massachusetts collects taxes quarterly. For New Hampshire, we need 6 months of escrow payments because they collect taxes twice a year. In New Hampshire, we also have transfer taxes. So if you are going to buy a house in New Hampshire, that is something that you should note, that for closing, you're going to have to add in that transfer tax bill as well. Next is mortgage insurance. Like I said before, there is no upfront mortgage insurance premium like an FHA loan. What the conventional loan program has is called PMI, or private mortgage insurance. It's the same exact thing as the monthly mortgage insurance premium for an FHA loan. It's just called something different. This you can get rid of when you have an 80% LTV on your loan. Okay? You have to request to get rid of it, but there is an option to get it removed. it will automatically be removed at a 78% LTV. Okay, so it won't be long after that, it'll automatically be removed. So if you forget about it at 80%, I wouldn't stress about it too much. Okay, but again, 78% it gets removed. You're probably wondering what LTV is. LTV equals loan to value. So if we have a $100,000 appraised value house and you take out an $80,000 loan, you have an 80% LTV, or another way to say it is 20% equity in your house. All coincides with each other. So again, in that example, if you had $80,000 left on your loan, you could request to remove PMI, but it will automatically be removed when you get to $78,000 remaining on your loan. Qualification, as we went over before, 50% DTI is the absolute max. A lot of lenders are going to ask for 45%. Okay, so really I would focus on that 45% number because that is definitely preferred by most lenders. All the lenders that we work with require a 45% debt to income. Okay, so 45%, don't stress about the 50. We want 2 years of stable work history, just like an FHA loan. It is okay if you switch jobs in that time. We're just going to need more verification of employment to make sure that it is stable. And then after that, we just need a higher than 680 credit score. The higher your credit score, the better interest rate you're going to get. So that's another thing to note. If you have higher than a 740 credit score, you're going to get the best interest rate possible. Okay, you're not going to get a bad interest rate if you're at 680, but just know the higher your score, the lower the interest rate. Next, we're going to go over seller concessions. Another way to word that or phrase that is that the seller helps pay for your closing costs. This cannot be used for your down payment, but again, they can help with the closing costs. So with the broker fee, title fee, any escrow payments, the seller can actually help you with that if negotiated in that contract. The amount that the seller can help you with depends on the down payment amount. If you make a down payment of less than 10% on the house, the seller can help with 3%. And that 3% is of the loan. So that's not 3% of the closing cost. If you have a $100,000 loan, the seller can help you out with $3,000 of the closing cost. If you make a 10% to 25% down payment, the seller can help with 6%. So again, in that example, they can help with $6,000 of closing costs. And if you make a higher than 25% down payment, the seller can help with 9%. So again, to go back to that example, they can help with $9,000 of the closing costs. So again, you get rewarded for a higher down payment by possibly the seller paying for more of your closing costs. There's a lot of positives with this. Two big ones: you can make a higher down payment because you technically have more cash to put towards that down payment since you won't be paying for closing costs. And just that, you're not paying your closing costs. The seller is paying it for you. The drawback is that there's a greater or a higher loan amount. Okay, how this would work, a $100,000 house, we'll go back to that example. Let's say you put 10% down. So you put down $10,000. The seller can help with 3% of that closing cost. For example, if we go back to that $100,000 loan that we were talking about before, okay, let's say you offer $100,000 on the house, but you want the seller to pay for 3%, or you want these 3% seller concession, you would have to offer $103,000 on the house so that way the seller can pay the 3% concession. So yes, you're taking out more of a loan, but you do not have to pay for the closing costs. That's what I mean when it says that there's a greater loan amount. You're going to have to offer higher than the list price to compensate for the seller paying for that closing cost. Next is the refinance options. Okay, it's very similar to an FHA, it's just terminology can be a little bit different. There's a rate and term refinance. The biggest thing with this compared to an FHA streamline is that we do need a new appraisal. Okay, we need new proof of income. We need to make sure that there's not a lot of debt. Your credit score needs to be repulled. So there is a little bit more paperwork and a little bit more that goes into it for a conventional loan, but again, that's still that we can meet the standards of Fannie Mae and Freddie Mac. The next option is called a cash out refinance. That's when we pull out equity in our home and we actually receive a check at the closing table. Okay, so this is calculated by finding 80% loan to value and then subtracting that from the total amount owed. So we have an example here. We have a $100,000 appraisal. Okay, we want to do a cash out refinance. We need it appraised. So we get the appraisal, it comes back at $100,000. That's what your house is worth. Okay, 80% of that would be $80,000. Let's just say in this example you have $60,000 remaining on your loan. You are able to take out $20,000 from the equity in your house to use, again, for whatever you please. If you want to do home renovations, if you want to just create a little buffer in your savings account, whatever you want to use that money for. Okay, but it is important to note that the loan that you're taking out in that refinance is now $80,000 instead of $60,000. So that's why we need that 80% LTV, so that way there's no mortgage insurance needed. Next is going to be the loan limits. Very quickly, just going to go over the base loan limit is going to be $548,250. That's kind of base level. If you're in a high cost area, the loan limit is going to be $822,375. Okay, different counties around the country have different numbers, but the lowest number that you're going to see is that $548,250. The highest number you're going to see is the $822,375. It is very important to note that if you go over that loan limit, it's not that we can't lend to you, it's that you're going to be in a completely different loan program that we call a jumbo loan. Okay, that requires completely different underwriting standards, completely different guidelines, and a lot of different qualification standards. So if you want to get a conventional loan, you're going to want to make sure you stay under those loan limits. Your loan officer should tell you what those limits are. They're not just going to lend you a loan without you knowing what the guidelines are. So you should be well informed, and your loan officer should make sure that you are well informed of what the limit is in the area that you are looking. So that's really it for a conventional loan, just a really basic overview. Again, if you have any questions at all, I'll be here to help you. My name is Matt McDonald again. My number is 603-475-5471. My email is mmcdonald@pmlhomeloans.com. And any questions at all, don't be afraid to reach out. I'd be happy to help. If you could like, subscribe, comment below, it'd be greatly appreciated. Thank you, guys.